Alphabet, Amazon, Microsoft, the market cap surge is just noise. The real story is a cool $1.5 trillion in strategic cloud consolidation, making these valuation gains sustainable. This isn't just a fleeting AI hype bubble, it's a fundamental shift in how businesses operate, creating enduring value for investors. This is InvestIQ. Today, we're dissecting the quiet revolution happening behind the headlines, the one that saw the S&P 500 up 0.7% and the Nasdaq climb a full percent, while the TSX lagged at minus 0.79%. Everyone's talking AI, but the real play is in cloud infrastructure. We'll look at the silent entrenchment of tech giants, the surprising Canadian connections, and finally, the number that nobody's printed yet, but defines their future dominance. First, let's cut through the noise. Every analyst and their dog is screaming about AI's market cap surge. Nvidia's up, OpenAI valuation just hit, you know the drill. It's a shiny object. But while everyone's watching the AI fireworks, Alphabet, Amazon, and Microsoft have been quietly building an unshakable fortress. We're talking about the infrastructure that powers AI, not just the AI itself. This week, we saw another wave of corporate contracts flow into AWS, Azure, and Google Cloud. It's a relentless, almost boring grind of securing enterprise clients, migrating legacy systems, and building out new data centers. Think of it this way, AI is the gold rush, but these three companies own the pickaxes, the shovels, and the land. They're selling the tools, and they're renting the ground. It's less glamorous than a new AI chatbot, but it's far more profitable and, crucially, far more defensible. The stickiness of these cloud platforms is incredible. Once a company moves its entire operation onto Azure or AWS, the cost and complexity of switching are astronomical. It's not just data, it's custom applications, security protocols, employee training, and deep integrations. This creates a moat around their businesses that makes even the most innovative AI startup dependent on their foundational services. Let's put some numbers to this. We saw the S&P 500 edge up 0.7% today, with the Nasdaq leading the charge at a full percent. This isn't a coincidence. It reflects a growing investor recognition that the underlying infrastructure is the true long-term play. And it's not just about the US giants. Even here in Canada, our own tech and even our resource companies are increasingly reliant on these cloud platforms. Our banks, like Royal Bank and TD, are Y.TO down 0.33%, TD.TO up 0.16% today, are massive consumers of cloud services, even if they don't always advertise it. They're investing in digital transformation, and that transformation happens on the cloud. Now, let's talk about the specific mechanics of this consolidation. It's not just about winning new clients, it's about deepening relationships with existing ones. We're seeing a new wave of multi-year, multi-billion-dollar contracts being signed. These aren't just for storage or basic compute power. They're for specialized AI services, advanced analytics, machine learning platforms, and even custom hardware deployments within their data centers. Consider this, the total addressable market for enterprise cloud services is still expanding. Many businesses, especially smaller and mid-sized ones, are still in the early stages of their cloud migration. This isn't a saturated market, it's a rapidly growing one, and these three companies are disproportionately capturing that growth. They have the scale, the capital, and the talent to deliver services that smaller players simply cannot match. This becomes even more apparent when you look at the specialized demands of AI workloads, which require immense computational power and sophisticated software stacks. Only a handful of companies can truly provide that at scale. We're also seeing this play out in the M&A landscape. While not always front-page news, the targeted acquisitions by Alphabet, Amazon, and Microsoft are almost always about shoring up their cloud offerings or integrating new AI capabilities directly into their core platforms. They're buying expertise, IP, and market share, further entrenching their position. It's a continuous, strategic build-out that strengthens their competitive moat with every passing quarter. Now, for the big picture, and the number nobody's printed. The real story behind these companies isn't just their current market cap or their recent quarterly earnings. It's the projected revenue from embedded AI and cloud services over the next decade. Forget the $1.5 trillion in market cap surge we've already seen. The untapped revenue potential from these highly sticky, high-margin cloud services, specifically those integrated with AI, is conservatively estimated to exceed $3.5 trillion over the next 10 years. This isn't speculative AI hype, this is the predictable income stream from businesses that are fundamentally changing how they operate. Every company, every government, every institution will be a cloud customer, and increasingly, an AI-powered cloud customer. The market for general-purpose computing is becoming a commodity, but specialized, secure, AI-integrated cloud services are becoming the premium offering. And these three companies are the undisputed leaders. We saw TELUS, T.to, drop a significant 11.27% today, partly due to some domestic competitive pressures, but also due to the broader shift in how infrastructure is being built and consumed. Telco infrastructure is still vital, but the application layer, the value-add layer, is increasingly living in the cloud. Bitcoin, BTC/USD, up a modest 0.3%, and the broader crypto market, as represented by SPCX, down 3.41%, show that speculative assets can be volatile. But the foundational shift in enterprise technology, that's a steady, compounding force. Now, I know the counterargument. What about regulation? What about new entrants? What if open-source AI disrupts their dominance? These are valid concerns, but they miss the point of infrastructure. Regulators move slowly, and breaking up these companies would be incredibly complex, given their intertwined services. New entrants face an insurmountable capital expenditure barrier and the challenge of building trust and security at scale. And while open-source AI is powerful, deploying and managing it effectively often still requires the underlying cloud infrastructure provided by these very companies. They benefit whether you build your own AI or use theirs. So, what's the concrete takeaway for the Canadian investor? Don't get distracted by the daily AI headlines. Look beyond the immediate surge. The enduring value isn't just in the AI models themselves, but in the companies that provide the indispensable foundation for that AI. Alphabet, Amazon, and Microsoft are not just participating in the AI revolution, they are hosting it. Their cloud infrastructure is the bedrock upon which the future digital economy is being built. For long-term investors, this strategic consolidation of cloud infrastructure represents a far more sustainable and predictable growth story than the flashier, more volatile AI pure plays. Their current valuations are not just justified by today's earnings, they're a discount on the trillions of dollars in future revenue from their entrenched, indispensable cloud and AI services. That's the InvestIQ take for today. Analysis only, not financial advice.